We saw the journal article, and we talked about it here a few times, and I saw your quote in here, so I wanted to follow up with you. You guys have done a lot of research in this, and the deck is obviously a ton of charts. It's real complicated to the average person. So tell us the general takeaway. What is this concept of gamma selling, and what does it mean for the market?
Sure. I mean, yeah, appreciate you having me on. This is a lot of fun. So the way to think about it is this, right? Options are a little niche in the marketplace that most people don't think of on a day-to-day basis, right? But these days, big institutional investors, think, giant pension funds, do a ton of option selling just as part of their equity portfolio management, right? So there'll be, big pension funds long $100 billion of stock, they might overwrite, they might sell, 10 or $20 billion of calls against it just to say, hey, why not take some income against my equity portfolio, right? That stuff is all now very big size. And the way to think about it is when they do that, the dealers who sell them those options, they have to trade against the market in a sense, right? Every day the market's up, dealers have to sell stock to re-hedge those options that they're long. When the market goes down, dealers have to buy them, and dealers sell some of those options to volatility traders and so forth. So it's sort of as if all those pension funds have decided to actively rebalance their equity portfolios every day. So the key thing to understand is it really, especially when everything's been quiet, it creates a lot of pressure to reduce volatility in the marketplace, right? Market tries to go down, but there's just a lot of mechanical buying that has to happen in order to re-hedge options selling positions. So that's really what we're talking about, is that effect.
Okay, so to me, just to kind of continue to kind of break this down, it seems like a counter force that these big managers who engage in these strategies, bring into the marketplace. But my takeaway from the journal article and your guys' work is that the proliferation of this strategy is what now might be, I don't want to put words in your mouth, is it changing the magnitude? Is it exacerbating direction? What is the real effect in moments like Q4 18 when they have big moves to make basically to get in the market? We've got some of your bullet points up here.
Yeah, absolutely. I think that the key thing to think about is, think about what the last few years has been like. It gives rise to this phenomenon where you'll have a few months where the market just feels dead quiet, right? Very low volatility, slow drift up or maybe slow drift down. And then you'll have a month or two that feel really exciting where everything's moving, big, like Q4 last year, right? October, November, December, having 2 or 3%, sell-offs and rallies. And the reason for that is that when large institutions engage in these types of strategies, they're selling very short-term options. And that rebalancing effect that's created by those short-term options is very strong when the market is trading right around the strike prices of those options. Mm-hmm. So today you think the S&P is at 3,000. So if an institution is selling a bunch of 3,000 or 3,025 calls, there's going to be a very strong counterbalancing market, effect right around that price. But say the S&P drifts down, to 2,800 over a couple of weeks. Then all of a sudden, all those options struck at 3,000 or 3,050 have almost no impact on the market. And now if we have an actual event, if there's some bad headlines, then we can sell off 2 or 3% and enter a different regime for a few months. So I think it's really that bipolarity of markets that's really interesting.
It's interesting. So now this is not necessarily a verdict on the sort of swings at any given moment, but the fact that the market can change so quickly. A lot of times when we have these events, it's tempting for people to just write off saying, oh, it's HFT or it's risk parity or it's this and that kind of a boogeyman that is causing swings. But that being said, if you do have an increasingly popular strategy, until it gets arbed away, is there potential to push the market in a direction that maybe goes irrespective of whatever the theoretical value of those stocks are? Does it have capacity to impact the market in a way that it quote unquote shouldn't?
Yeah, it can in different kind of ways. I'll give you one example. Let's say that the market's been drifting up, and things have been relatively quiet, right? And large investors are selling call options. And what ends up happening is the week before expiration, typically all those options that large pension funds have been selling are deep in the money. And so when those pension funds go to roll those options into the new month, they have to buy back call options, which are very deep in the money and which are very sensitive to equity prices. And then, so they buy those back and then they sell new options that are further out of the money, higher strike prices. And when they do that, they're buying equity in order to do that, just mechanically. And so you can tend to have, a rally in the market be exacerbated, kind of a slow melt-up rally be amplified by that type of effect. Same thing with a slow sell-off can be amplified in the same way. So in December, think of just how trendy the market move down was, right? Things were relatively volatile, but the amazing thing was just every day we were selling off 1.5% or 2% in a very, very trendy way, right?
You guys have a chart that looks at net option flows over the past basically like 14 years. I think we've got, if we can bring it up, on one axis shows the gamma exposure, on the other the vega exposure. You can see clearly how this is developed in terms of the net exposure, which moves to the downside on the chart over the past couple of years. Ben, can you clarify for viewers who remember the vol explosion at early 2018? We associated that with the short vol trade blowing up, and we've also got the chart obviously looking at the nature of the exposure from the Wall Street Journal. But putting this together, how are the two related? Because what you're talking about is just general option selling, but we saw how this is exacerbated in early 18 when that selling happens basically in one direction.
Yeah, absolutely. So these are definitely related things, but they're quite different in one important way. So early 2018, that blow up in February, that was a pretty specific blow up of one pocket of the world, which was VIX-related products, right? Yeah. So that was largely a retail trade, retail investors who were, who had done quite well the past year or two, being short VIX futures or being short VIX ETNs like the VXX, or being long products like XIV, which implicitly were short VIX futures. And that's a sort of a carry trade under certain market environments that can make money over time. But I think it's also a relatively complex trade that a lot of people didn't understand and piled into probably much bigger than they should have been. That trade became very, very crowded. And there were, various reasons why. At some point, it really became something that looked, I think, to professionals like a ticking time bomb, where you didn't know when it was going to blow up, but it seemed highly likely that at some point in the future it would, and that turned out to be early February 2018. So, oh, go ahead.
Well, I was just going to ask then, if you have, that was a retail trade, is there any risk in your mind that the institutional investors who are employing these strategies, if they find themselves aligned in one direction during these either a melt up or a melt down, how is that going to affect really trading? I know that you pointed out from an options standpoint, we've got a lot of options traders that watch sort of the different relationship that SKEW now has at the beginning of a sell-off. I thought that was kind of interesting.
Yeah, so it has some nuanced impact. So first point is, it is very different than the early 2018 Volmageddon, where you had over-leveraged retail investors that didn't necessarily understand the risks that they had, and it was a very highly leveraged position, and so you had the mini blow-up. What we're talking about primarily here are large, deep-pocketed, real money, pension funds who are overwriting some percentage of their equities, for example. So that's very, those trades can underperform over time, but they're not trades that blow up in any kind of way, right? So that component is very different. But in terms of the types of effects that they can have, yeah, so you alluded to the unusual impact on SKEW. So one example, SKEW, just for folks who don't know, is typically we refer to what's the premium that the market charges you for downside puts versus upside calls. So you think of, typically people are willing to pay up to be protected against a market crash, and typically downside puts trade at a higher implied volatility than upside calls, and they should. And typically SKEW, if anything, at least goes up or stays the same during a major market sell-off. In Q4, we saw something very unusual from a historical perspective, which was SKEW, so the relative price of downside puts, actually falling very steadily to very low levels during a market, significant market sell-off. That's very unusual. It was largely, the reason it came about mechanically was really had to do with some of these large option sellers in the institutional space who were managing short downside put positions and continually rolling them further and further down as the market went down, and they were very large. So, unusually you had net selling of downside puts, where normally you would think of, oh, it's a market sell-off. Aren't people buying puts? Aren't they panicking? That wasn't what was happening at all.
Interesting. Hey, Ben, real quickly before we let you go, we could keep talking about this, but when I envision big institutional traders like you're describing with huge options positions, it sounds like those, from a retail standpoint or a smaller investor standpoint, that their boat is kind of getting increasingly small in pretty big waves. How does this affect kind of vol pricing? Or I think we kind of see that in SKEW, right? It definitely does.
Yeah, it absolutely does. I mean, these are the types of trades that affect vol pricing, right? And the dominant flow these days in S&P options certainly is the selling of relatively short-term options for income by large institutional investors. So one thing that does, if you just compare the volatility term structure in the S&P over the last, say, 5 years on average to what it looked like in comparable, relatively quiet market environments before 2008, now it's much steeper, right? So the front, short-term equity options might trade at 8 or 9 implied volatility, whereas, that would have been more like 12 or 13 or 14 in comparably quiet market environments, in 2006 or something. And then the curve is much steeper, right? Where longer-term options trade higher. So that's one very clear impact of the heavy selling of short-term options by large institutions relative to more mixed flows and net protection buying in the middle of the curve and further out.